Hey, what's up, my friend? So I know you're watching this video, right, because you want to better time your entries, right? Perhaps you're the type of trader that always seem, right, to be entering the trades too late, right? By the time you enter the trade, the market does a reversal or a pullback and you get stopped out of the trade. Or maybe you're the type of trader that somehow you're always entering your trades too early, right? You get the direction right, but the funny thing is that you're too early, you get stopped out before the market continues to move in your favor. So if you happen to fall in any of these two categories, don't worry, because in today's video, I'll share with you, right, a few of my secret techniques, right, to help you better time your entries with deadly accuracy. Okay, so here are a few things that you will discover, right? We'll talk about why you must or why you should trade from an area of value, not away from it, how to get help from the higher time frame, and why you don't want to be chasing big moves in the market, but you should do this instead. So all this and more, but first, right, if this is the first time you're watching this video, this is the 10th time, the 20th time, right, here's what I want you to do, right, hit the thumbs up button, right, hit the thumbs up button and subscribe to my YouTube channel. The link is all below. Just click on the subscribe button. This way, whenever I publish a new video, you'll always be up to date. Sounds good? Then let's get started. Number one, trade from an area of value, not away from it, right? This means that you want to avoid taking trades from an area of value. So let me explain what I mean by this concept. So you can see over here, right, this chart, this is the 30-year Treasury bond futures chart. And one thing you know is that this market right now on the daily time frame, it's in an uptrend. In fact, it tends to respect this 50-period moving average, right? Tested once, twice, and thrice over here. So you can see that based on this chart, the area of value is about or around the 50-day moving average. So somewhere about here. So if you recall earlier, I said that you don't want to be trading far from an area of value. Why is that? Okay, so let me explain why. If you look at this, right, if you were to be entering your trades right now, let's say you buy somewhere here, and you know that the area of value is somewhere here, what happens is that this market, it has a tendency to pull back towards the 50-period moving average. So if you were to buy somewhere here, and if your stop loss, right, let's say below this swing low, or here, it's not going to save you, because when the pullback comes, right, let's say the pullback comes, there's a good chance it's going to retest back this 50-period moving average and then continue higher. So if you put your stop loss, right, anywhere in this area, chances are you're going to get stopped out. So this is why I say that you don't want to be trading away from an area of value, but you want to be trading near an area of value. Because now, let's imagine this. Let's say you're patient. You let the price come to you. You trade from an area of value. And the area of value is over here. Let's say the market retests down lower, right? And it maybe had the price rejection closing up slightly higher. So now, if you trade from this area, your stop loss now can go somewhere about here, right? A distance below the 50-period moving average. And now, you're trading near the tail end of the pullback, right? Where the pullback is, likely to end. You're trading near the tail end, right? And that offers you a much more favorable risk to reward, right? Because the market is now getting ready, right, to make the next leg up higher. So remember, right, you don't want to be trading away from an area of value. You want to be trading near the area of value. You will have a tighter stop loss, right? And it offers you a much more favorable risk to reward on your trade. Okay, and again, one more thing to add is that for those of you who look at this chart and say, oh man, Rayner is so bullish, man, I can't wait to get on board the move. Okay, and if you were to enter over here, okay, logically your stop loss should at least be below this 50-period moving average. It's going to be somewhere here. And if you were to enter there, you can see that your stop loss, the size of it, is going to be pretty darn large. This is your stop loss. Okay, and you can see that entering your trades far from an area of value, it doesn't offer you an attractive risk to reward compared to a trader who is patient, who let the price comes to them, right? Let's say the price comes down lower to them. Let's say they enter somewhere here. Their stop loss, let's say, is at this level. Now their stop loss is much tighter. They can afford to put on a larger position size and still keep their risk constant. In other words, they are trading from an area of value and it offers them a more attractive risk to reward. Okay, so that's concept number one, all right? Or rather, my secret number one. Number two, get help from the higher time frame. So what do I mean by this, right? So this concept is, let me just, illustrate it over here. So when you, let's say you look at a chart on maybe the 4-hour time frame, right, and the price is, let's say, in this range over here near this lows at this point, okay, at here on the lower time frame. So this, right, is this area will be more significant, right, if it coincides with a higher time frame level, if it coincides with a higher time frame market structure like support. So if let's say this is on the 4-hour time frame, right, you know that this level over here is going to be more significant if on the daily time frame it looks something like this. Let's say the daily time frame is in an uptrend and come back and retest this level of previous say resistance now acting as support. So now this lower time frame support, right, is actually leaning against a higher time frame market structure, and that improves, right, the odds of your entry. So let me give you an example. Okay, if you look at this, right, the 4-hour time frame, at this point, right, you might look at this and say, oh, this is nothing significant, right? The price is now just, forming a range over here, nothing special. But remember what I said, right? If the price is leaning against a higher time frame structure, right, that level becomes even more significant. So you can see that over here, this area over here is actually leaning against a daily time frame level at this point over here, right? This previous resistance now acting as support. So you can see that the consolidation that you saw earlier on the 4-hour time frame, this portion over here, is actually leaning against a higher time frame previous resistance turn support, and that's a significant level. And if you were to have your trades usually leaning against such higher time frame structure, right, you will find that the probability of your trades, right, your entries will be improved. So in this case, okay, the market did breakout, right, retested this area of resistance before collapsing. But that's besides the point, right? The key thing I'm trying to share is, pay attention to where the market structure is at on the higher time frame. If it's leaning against a higher time frame, all the better. So let me give you another example, right? Because this concept is it's important. Again, the 30-year Treasury bond, right? Let's look at the daily time frame. Okay, let's look at the lower time frame. Let's look at the 8-hour time frame. Okay, so again over here the 8-hour time frame, right? Just ignore the lines for now. You notice that here the price at this point, okay, the price retested this area of support on the 8-hour time frame. One thing to note is that if you look at the higher time frame, right, the daily time frame, you know that that area coincides with a higher time frame structure, which is actually the retest of the 50 MA over here, right? So what you saw earlier, that retest on the 8-hour time frame is actually this part over here. So if you look back historically, right, this market tends to respect the 50 MA, right? Tested once, twice, and now at the third time over here. Plus on the lower time frame, the 8-hour time frame, it's an area of support. So you can see that, multiple factors coming together, right? And area of support on the lower time frame is coinciding, right, with a higher time frame support, right, or market structure, right? It could be a trend line, it could be a moving average, it could be support, resistance, whatever. But as long as there are, areas or levels on the chart which coincide between multiple time frames, right, that level is enhanced. Okay, so that's secret number 2 that I want to share with you, right? You can get help from the higher time frame, right, to improve your trade entries. Because this time around, right, the attention, right, is not just on the lower time frame traders, but on the higher time frame traders as well. They're also paying attention to that level, and that could induce, buying pressure in your favor. Next, secret number 3, right? Don't chase big moves in the market. Do this instead. So here's the thing, right? Often, right, when you look at a chart, me, for example, when 8 years ago when I was trading, I'll look at the chart and say, man, look at a huge bullish momentum, man. Price is so strong, it's about to rally higher. Let me enter the trade, man. I don't want to miss the move, right? So let me buy right now. So let me give you an example of, what I'm referring to. So you can see that price now on the daily time frame, it has broken out. Right, man, this is so bullish, man. Rayner, it's time to buy. But if you recall, right, I shared with you earlier that you don't want to be trading far from an area of value. You want to be trading near it. So again, we can see that we are bringing back the same concept you've learned earlier. And if you think about this, if you were to buy right now at this price, at this, let's say at this 14.10 price, where is the area of value? Right? Well, from the looks of this chart, the area of value right now is possibly at here. Previous resistance now act as support. This means, right, that the price could actually retest back this area, previous resistance turn support, and then continue back up higher. Right? There's a good possibility that could happen. In other words, right, if you want to set your stop loss, right, it is not going to make sense to be putting your stops anywhere here, 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 or here. Because when the pullback comes, right, you will get stopped out. So the logical place to set your stops, right, is at least, right, below this market structure over here. Maybe possibly somewhere here, right, below this market structure, somewhere here. And you can see right now that if you were to have your stop loss at this so-called proper location with your entry over here, your risk to reward is pretty poor. Okay, so you can see that, if you were to enter with a very lousy stop loss, you're going to get stopped out. If you enter your trade right now with a proper stop loss, your risk to reward is very poor. So what do? Well, you let the market come to you, right? Don't do anything. Let the market show its hand, right? Let it form new market structure where you can reference, right, and set a proper stop loss. Okay, so this is what I mean by don't chase breakouts, right? Do this instead. So what you can do is, again, let the market show its hands. So what I usually like to do is to let the market form new market structure, new swing high and swing lows. So in this case, you can see that the market made, new swing high and swing lows, right? New swing high, new swing lows. At this point, now you have market structure that you can reference to. You can now reference this lows or this lows to set your stop loss. And another tip that I have for you is that when the market breaks out, when it's trending, you want to pay attention to, which moving average is it respecting, right? And usually in a strong trend, it tends to respect the 20 period moving average. So if we just pull out the 20 MA, notice that the price over here, right, seems to be finding support at the 20 MA. So now you have options now. You can either use the swing low to set your stop loss, or you can use the 20 period moving average, right? So now when you trade, right, you can still look to buy the highs of this, but your stop loss can now just go below this swing low or below this swing low, right? Maybe somewhere here. And your stop loss is now much tighter, offering you a much better risk to reward. And if the price were to, let's say, do a pullback, you know that this 20 period moving average will serve to act as support to hold up these higher prices compared to, previously where it wasn't acting as a support, right? The price will just retest back this market structure and you get stopped out. So you can see that how, right, if you let the price show its hands, right, trading becomes simpler. Okay? So the key thing is that if the price, it makes huge move, right, big body candles, it's usually too late to enter, right? It's more wise to take a step back, let the market unfold itself, and then plan your decisions accordingly afterwards. Okay, so that's the first thing you should do, right? Don't chase breakouts, right? You can look for a pullback or wait for new market structure to form. That's the first thing. Another thing that you can do is that besides chasing breakout is that, look for a build up to form. So let me explain to you what is a build up. So a build up, right, is so you look at this portion here, right? This is chasing the markets. This is buying, right, when the market is so bullish, right? But candles are big, and usually this is the worst time to buy because, as mentioned, right, poor stop loss placement, and chances are you're going to get stopped out on the pullback. So this, whenever I look at this chart, right, I think I look at it, right, as a form of energy being released, right? It's like, rah, energy is released, right? It's out, okay? And when energy is released, right, it's usually a poor time to enter because all the energy is already out, right? There's so-called nothing left in the move. And when I enter my trades, I want to enter when energy is stored, right? Potential energy where, it's getting, squeezed, getting tight. That's where energy is being stored and about to be released, right? You don't want to enter your trades when the energy has already released itself. You want to enter when energy is being stored. So how do you tell when energy is being stored? And this is where I mentioned, right, you want to look for a build-up, okay? A build-up, right, is essentially a tight consolidation, right, where the price gets squeezed, really tight. And I like to look for build-up, right, at market structure, a build-up forming at support, a build-up forming at resistance. So let me show you, right, what is a build-up. So at this point, all right, you can see that there is this area of resistance over here, and there's this tight build-up over here. Notice that this price action is so different from the energy that is released earlier. This one over here, the energy is being stalled, it's being constricted, it's being constrained. The price is like, let me out, right? So you can see that this is the constraining pattern that you want to look for, right? A build up, right? A tight consolidation, low volatility, whatever you call it, right? Just pay attention to this, okay? And this is where you want to get interested, right, in buying the breakout. This is where, there is potential for the move to really move. And one more tip that I have for you is whenever price is forming a build up, right? The 20 MA, right, prior to the breakout, the 20 MA will already start supporting the price. It would act as like a support, right, where the price would tend to bounce off the 20 MA. And you notice that phenomenon right over here, where the price has already started respecting the 20 MA, bouncing above it. Okay, so this is the resistance. This is the build up that's formed, and when you trade breakouts, you want to trade breakouts with a build up, and this is the build up that's formed. And you can simply have a buy stop order above this highs, or wait for a candle close above the highs, whichever you prefer. All right, usually if I see a nice tight build up, I just have a buy stop order above it. And in this case, right, this of course this is a cherry pick chart. Obviously I pick something that kind of proves my point, but again, don't take my word for it, right? Go out, test it, validate it yourself, right, and see whether it's true. And in this case, the market pretty much have a very nice big explosive move, after which, right, after a build up is formed. Okay, so this is powerful concept, right? Let me just explain this once again with another example, because this is really important. If you look at this, right, look left, right, this over here, what is this? Whenever I look at this chart, to me, that is energy being released, right? And you don't want to enter when energy has already been released, because the power, right, the energy, everything is gone already. It's out. There's nothing left. You want to enter your trades when energy is being constrained. And you notice over here, this price action is so different compared to the one you seen earlier. This is where energy is being stored, right? It's getting constrained, it's getting tight, it's getting ready to break out, right? And again, right, a quick tip, right, if the 20 MA, usually the price tends to respect it prior to the breakout. If it tends to respect it, all the more, right, that is like a big plus that you really want to be paying attention to the breakout. And in this case, just goes kaboom, right? Price just broke out higher. Okay, so this is a very important tip to share with you, right? Don't chase breakouts over here, right? Don't chase big moves, right? Do this instead. Look to trade the first pullback. When the market breaks out, there's a good chance you might make a pullback. Okay, and you can reference the swing high and swing low to set your stop loss, or you can look for a build up before the price breakout. That's another thing that you should do, right? Don't chase big moves in the market, because it's usually probably too late to enter. So a quick recap, right? Number one, trade from an area of value, not away from it. So okay, I think Bitcoin can also illustrate the example over here. So you see over here, okay, by now I hope you can see the point I'm trying to make. Bitcoin at this point, right, the 20 MA, right, seems to be the area of value, or at least this highs over here where previous resistance could act as support. And do you want to be buying over here at this highs? Well, 8 years ago, Rayner said, yeah, of course, buy. It's bullish, man. You should be buy. You should be long. Go all in, mortgage your health, sell your kids, and buy everything. But no, 8 years later, right, wisen up a little bit, right? When you see this type of price action where energy is released, it's usually too late to enter. Okay, market do a pullback, right? That's where your trading opportunity is much more favorable, right? In this case, right, you can see that the pullback, the price action that chop up back and forth, right? Energy is really being released, right? It's really too late to enter about here or even here. Okay, so that's a key point. The first point I made, right? Trade from an area of value, not away from it. Number two, you can lean against a higher time frame market structure to increase the odds of your trade working out, right? For example, if you identify a support on a 4-hour time frame, if that support is happen to be a daily time frame support as well, that really sweeten the deal, right? Number three, we talk about don't chase big moves in the market. If the candle is bullish, is bold, is big, it's probably too late to enter. Instead, what you want to do is trade breakouts with a build up that's usually prior to the big move is being made, or wait for a pullback, right? Like the example you saw on gold earlier, when the price breaks out of resistance, wait for the pullback to form, right? Let the 20 MA catch up with price, right? When that happens, right, you have new market structure to reference to, right? You can trade the bullish flag pattern, the pennant, whatever. You have market structure that you can reference to set a proper stop loss. Okay, so with that said, I have come towards the end of this video. If you want to learn more, right, if you really enjoyed what you've learned so far, here's what I want you to do, right? Go down to my website, tradingwithrayner.com. The link is on top, right? And scroll down a little bit. You will see this guide over here, the ultimate guide to price action trading. That will really complement what you've just learned earlier. Okay, this one will talk about how to time your entries and exits, right? And read the price action of the markets. Just click this orange button, enter your email address, and I'll send it to your email for free. Okay, so go and do it right now. And with that said, right, hit the thumbs up button, subscribe to my YouTube channel. I wish you good luck and good trading, and I will talk to you soon.